Hi, welcome to the Resources Roadhouse. I'm Wally Graham and I'm at the 2019 New World Metals Conference in Perth, and I'm speaking with Mike Young, who is Managing Director of Vimy Resources. Mike, you've got your two uranium projects. You've got Alligator River and Mulga Rock, and you're currently, they're both at different stages of development. I'll get you to touch on that in a minute. And also, if you could sort of also reflect on both projects in respect to the state of the global uranium market at the moment. I mean, things are probably a lot tougher in there that you'd like them to be, and maybe they're making life a little bit more difficult for you than you'd like, but let's expand on that. So we'll start with the projects.
Sure. So Mulga Rock project is in Western Australia in the Great Victoria Desert, east of Kalgoorlie. Finished a DFS on that almost 2 years ago, and then basically in effect parked it because the market wasn't where we needed it to be, as you've alluded to and we'll discuss. And then the Alligator River project was a project we bought from Cameco Australia, which is a major Canadian uranium company. They basically looked around the world and looked at their non-cash producing assets and decided to get rid of them. So they closed an office in America, the marketing office, and that's relevant to us because we picked up a uranium marketer who works in America for the Mulga Rock project. But we picked up the Alligator River project, and that's sitting in a really unique geological province, which is very similar to the Athabasca Basin in Canada, which is where some of the world's biggest uranium deposits occur. So the Alligator River province hosts both the Ranger mine and the Jabiluka deposit, which are absolutely world class.
Yeah.
So those are our two projects. The Alligator River project has a resource which has been defined at inferred, so that needs obviously infill drilling. So that's probably a 5 to 7 year window. And then Mulga Rock is ready to go when the uranium market recovers.
Okay, well, as you just said, when it recovers, it's not in the doldrums, or is it?
Oh, it is.
Yeah. Okay, so what's the main sort of thrust behind that?
So the uranium market's an interesting market because what people see and what's reported is the spot price. And I use the inverted commas because it's not really a spot market. It's not a market like nickel or copper or gold where you have total transparency. You've got a trading house, pounds go in, pounds go out. The spot market is actually it's a very thinly traded arbitrage market. It's a lot like the LNG market, where over 90% of the uranium that's traded is traded on long-term contracts between a producer and a utility all over the world. And those contracts can be anything from what we call market related, so they are linked to the spot market, but more often than not, they're what we call base escalated. So that would be a negotiated floor price and some sort of escalation based on, say, CPI or production or certain targets. So that's normal. And as I did in my presentation and the presentation that's online, what the U.S. is, where most of the data comes from, what the U.S. is paying for uranium is anywhere between $25, which is the spot price, and $75, because those are contracts. Uranium, as an input cost to the production of electricity, which is what it's used for, is a very low part of the input cost. Most of the cost of nuclear electricity is capital payback. These are large projects. They cost several $1 billion to build. They last for 60 years. So there's this capital payback component of the cost of electricity, and uranium's a small part. So what happens with uranium is it's about security of supply. Now, over the last several years, the Kazakhs, who produce most of the world's uranium, overproduced. They believed wrongly that they could corner the market and become the OPEC of uranium. They miscalculated, they overproduced, and the uranium price basically fell away to where it is today. However, long-term contracts were still being honored, and the Americans were still paying for uranium and higher prices, and we need to capture that market. So we need to ignore the spot market, although it drives sentiment, and we'll come to that. And our job is to go out to the U.S. utilities as they come into the next contracting cycle and sell our uranium at $55 plus.
Right. Okay, so once you sort of do that, that will then sort of, or basically finance the project?
Yes, that's a very good point. So going back to the spot price drives sentiment. Low spot price means low share price, okay? So with uranium, because 90% of it is, plus 90% is contracted, our development of Mulga Rock will be what we call contract-led. So we need to get contracts first, and those contracts need to be at a price and a volume that will support bank debt. And so we're already talking to debt financiers and advisors. So we know what price we need to get. So you get the contracts, you get the debt, and then once you have both of those, you would expect, in a normal market, but nothing's normal these days, as you know, but in a normal market, you would expect a significant re-rating, meaning your share price increases, your capex goes up. So let's say, we do those things and our capex is no longer 30 million, it's 130 million. Then getting equity to top up the rest of the debt, or the rest of the capital cost, is actually not that big a problem. Now, the other advantage we do have is that a contract is effectively a hedge. So you've got a forward contract with a U.S. utility, so your counterparty risk is low. And what that means is you can leverage up. You can actually do more debt than would be normal for a commodity like nickel or copper, where you have to forward sell and sell your soul to the devil to get a So basically, contract led leads to debt, then equity. So that's how we'd see getting there. Now, when will the prices go up? Okay. We're coming into a period of undersupply. We've seen, over the last 5 years, we've seen oversupply. We've seen inventory buildups. Mines have stopped. McArthur River, 10% of the world's production, stopped. Kazakhstan, 40% of the world's production, cut back. New mines not starting, new exploration not even being done. So we're seeing the beginnings of a shortage.
Yeah.
That shortage, you can literally see the shortage biting in about 22, 23. Now, when you look at that timeline, you think, wow, that's a long time away, But the utilities, they think on 30 and 40-year timelines. So they're looking at that going, we got to start writing contracts again. There's been political headwinds in America that have prevented them getting into the contract market. We're now coming into eggnog season, as they literally call it in America. And what happens is in January, they come back to the table. So we're looking at, our timetable is writing contracts during the first and second half of 2020 and then moving towards financial investment decision. Those contracts will be for even though they're being written 2020, they'll be written for first delivery in 23.
Yeah.
That's what they do. They do long-term contracts.
So basically you can get your contracts in line next year, and once that sort of happens, then you can go, okay, bang, let's start, so that we're ready to start moving stuff in 23.
Yeah.
Yeah. So, as you said, that's not a long time. In the grand scheme of things, like 3 years is not as long as 8 years, and
no,
so
that's exactly right.
And so, basically, it means that once things are in train, that there's really that starts happening.
Yeah, and we don't pull the button unless we've got the funding.
Yeah,
and we don't get the funding unless we have the contract. So, it's actually, even though it's frustrating from when I look back at other companies I've been associated with where the timelines have been much more compressed, it's actually bearable, I suppose, because once you have the contracts and have the debt, it's a sure thing.
Yeah.
You've got that certainty. And so what it means is that you're not building a plant thinking, gosh, what will the price be in 2 years? I'm taking a big risk. You're going, okay, all the risk is mitigated, because technically the risk of Mulga Rock is very low. It's a very simple deposit with a very simple process.
And that's what I was just about to sort of ask that too, because people would be saying, oh, okay, so you're playing this waiting game, but you're playing this waiting game based on two projects that you have already demonstrated to be worthwhile waiting for.
Correct, that's exactly right. So we have done a scoping study on Alligator River, and while it's inferred and we can't talk specifically about the economics, we have said publicly it's a Tier 1 asset, which means it's a very low cost mine. The territory is actually a good jurisdiction to work in. They have very strict environmental guidelines, as they should. We're in Arnhem Land, so we have to do 2 years of studies, and we've already commenced those because the deposit would be underground, so we know the footprint, and we know. So we're starting to get on top of that. So that would come in and say the mid to late 20s. Now, again, it sounds like a long way off, but the utilities, these guys think in 30-year window. And what was interesting is we had Mulga Rock, and we would say to people, look, there's a 15-year mine life. There's probably another 5 at the end of it. So that's a 20-year mine life. Isn't that great? The utility's like, well, actually,
it's not long enough.
We get an 80-year, if you get anything else, you go, well, we get the stuff in the territory, so we could have like 30 years. And they're going, okay, that's what we want to hear. And what's interesting is talking to the utilities, they're already asking us about, well, when you get, angularly up and running, will we get a slight discount? And you go, well, I hadn't thought of that, but yeah, we can talk about that.
Yeah.
So, that's how they think. And unfortunately, if you want to find a market that's more mismatched with equity, how equity players think, the day traders and the hot copperites and all those, they don't think in 4 or 5 year windows. They think in 4 or 5 minute day windows. And good luck to them. That's it's great. But we got to think long term, and we have been. And we've done it. I think we've done a good job at minimizing expenditure without gutting the company and losing IP. So you need to be ready. And I had this great question in the States. So there was an investor in the States said to me, "Why don't you just drop all your pencils and wait for the market to recover?" And I said, the trick is knowing how many pencils to drop.
Exactly.
Because if you drop them all, you're going to miss it.
Yeah.
And so I think we've found a good balance.
Yeah, especially if you don't have a sharpener. Very good.
That's right.
Yeah. Well, Mike, it sounds like, it is a waiting game, and sounds like you'll have a little bit more news on that waiting game starting, early to mid next year. So no doubt we'll be hearing all about that, and we'll bring it to people here on the Roadhouse.
Well, a good metaphor, because this is Australia, is motor car racing, and the grid is a waiting game. But you want to be 1, 2, 3, 4 on the grid, and that's where we are.
Okay.
So we're at the front of the grid.
All right. Well, that is a good metaphor. Well done.
Thank you.
Yeah.
I've been in Australia 32 years.
Yeah, it's not very often that you surprise me like that, but you surprised me today. All right, Mike. It's good to see you, mate.
You too, Will.
Thank
Thanks,
you.
mate.